The previous few readings dealt with present value models. Now we move on to market-based valuation. And here we will focus on price and enterprise value multiples. So we'll talk about price and enterprise value multiples in valuation. One of the most common multiples is the price to earnings multiple, but there are obviously many other multiples that we'll talk about. So we'll talk about that here with price multiples. We'll also talk about enterprise value multiples. So price here is the price of a share. Whereas when we talk about enterprise value, here we will consider the value of an overall enterprise. We'll discuss international considerations. We'll also talk about momentum valuation indicators. And the last segment of this reading will deal with issues that we have to face in practice in the context of valuation indicators. A very quick introduction. I'm sure you know this already, but just to get the ball rolling. Price multiples are ratios of a stock's market price to some measure of fundamental value per share. So always in these price multiples, the numerator is the current share price. Then the denominator could be earnings per share, book value per share, or some other measure. And we'll be going over several price multiples in this video. Then enterprise value multiples. These relate the total market value of all sources of a company's capital to a measure of fundamental value of the entire company. So notice that these multiples are from the perspective of a stockholder or an equity holder. But what if you want to take the perspective of all investors? Then the most commonly used enterprise value multiple is the overall enterprise value. And we've talked about this concept in an earlier reading. Divided by some measure of cash flow or some measure that applies to all providers of capital. And the one that is used most often is EBITDA. Just a few high-level remarks on price and enterprise multiples in valuation. Broadly speaking, we will be talking about two types of methods: the method of comparables and the method based on forecasted fundamentals. With the method of comparables, we use a price multiple to determine whether an asset is relatively fairly valued, undervalued, or overvalued. And you need to understand why this relative is so important. Since you are comparing with other companies, you can only say that this stock is overvalued, undervalued compared to the other company. So that's why we use the term relatively fairly valued or not. Now, before I get to this concept, I'll just very quickly explain what we are talking about here. Let's say that you are evaluating a particular auto company and the earnings per share on this particular auto company is 5. So 5 rupees per share or $5 per share. And a set of comparable companies have a PE multiple of 10. So what is the projected price or the anticipated price, assuming they are comparable? The projected price would be 50. So here we are using a method of comparables to come up with price. Now, what about a multiple? So let's say that the actual multiple for this company, it is trading in the market, and the comparables are on average trading at a multiple of 10, but your target company is trading at a multiple of 11. All else equal, is your target company, which is trading at a multiple of 11, overvalued or undervalued? It is overvalued because the price per dollar of earnings here is 11 for the target company, whereas for the comparable companies, that same multiple is 10. So our target company is overvalued. Now think about the underlying principle here. The underlying principle is the law of one price. In simple terms, the law of one price says that similar items should sell for the same amount. Okay, so what we are saying is if you have two auto companies which are exactly the same, then they should sell for the same price. Now, what if two auto companies are the same, but realistically their earnings are different? So one company has an earnings of 10 million, the other company has an earnings of 20 million. So are they same? Sort of, but not exactly. What we then look at is the price to earnings ratio. So what amount are you paying per dollar of earnings? And that's what the PE does for you. So if two companies are similar, just one is larger than the other, and this just connects back to something that you learned very early in your life when you talked about similar triangles. What are similar triangles? Two triangles that look the same but the size is different. So when we say similar companies, in a sense we mean the same thing. If two companies are similar, that doesn't mean the size is the same, it just means that they are same in all other respects. The ratios are the same. So law of one price would say that the price per dollar of earnings needs to be the same. In my example here, if for your target company the price per dollar of earnings is high, that means that this company is currently overvalued in the market. The other method is based on forecasted fundamentals. This relates the price multiple. Again, we'll take my favorite or most people's favorite multiple, which is the PE. And we are saying that for a given company that you are evaluating, the PE multiple depends on or is a function of fundamental factors related to that company. For example, if we say that the PE of a company depends on its growth rate, on its discount rate, on its some other factors that are related to this particular company, then we say that this PE is based on the forecasted fundamentals of the company. Again, we are coming up with a PE, but the method of coming up with the PE is different relative to the method of comparables. This is a very simple example of the method of comparables, and it is something that you have seen at level 1, but at times people are a little confused about this. So I want you to try this and get the right answer before you move on. So this is what you should get. If company A stock is trading at 37.50, its PE is simply 25. So this is the current market price divided by 150. If the companies are similar, this PE should indicate that company A is overvalued relative to B. Why? Because using this method, we are coming up with an actual PE of 25 based on the market price. But according to the law of one price, what is the PE? As in, the PE of company B is 22. So if the law of one price holds, and we are using B as our basis here, then A should also be at 22, but it's not. It is at a higher PE, so it is relatively overvalued. If we assume that company A stock should trade at about the same PE as company B stock, we will estimate that an appropriate price for company A stock is 33, which is simply A's earnings times 22. All right, now we come to the meat of this reading, price multiples, and we'll talk about various price multiples. Most of our time will be spent on price to earnings, but then we'll also look at price to book value, price to sales, price to cash flow, price to dividends, and dividend yield. This dividend yield is actually used much more often than a price to dividend ratio, so our focus will be on the dividend yield. Price to earnings. A stock's trailing PE ratio, sometimes referred to as the current PE, is its current market price divided by the most recent 4 quarters EPS, or earnings per share. In such calculations, EPS is sometimes referred to as trailing 12 months or TTM EPS. Sometimes, in fact, quite often in the financial world where we need to take a forward-looking perspective, we quote or are given forward PEs. These are also called leading PEs or prospective PEs. The forward PE is the stock's current price. So notice in both cases, the price is the current price. So if this is the current point in time, we take the price at this point in time. With the trailing PE, we divided price by a trailing EPS. With a forward PE, we divide price by a EPS in the future. Why use price earnings for valuation? In other words, why do you say that, look, this company should have a PE of 10, its earnings are 5, so the value should be 50? Why do we do that? A big reason is that earnings is a key driver of value. When you say this company is valuable or this company is not valuable, one of the most important things you look at is the earnings that are being generated by that company. Clearly, a company that is generating higher earnings should be more valuable than a company that is not generating high earnings. Number two, PE ratio is widely recognized and used by investors. In fact, if you look at sell-side research reports on several companies, one of the most commonly quoted multiple or a commonly referenced multiple is the PE ratio. So it is widely used in the industry. And three, differences in PEs may be related to differences in long-run average returns. This connects with a reading you did at level 1, a reading in equity on anomalies. You might recall that in looking at equity markets, one anomaly that was highlighted was that companies with relatively low PEs tend to outperform companies with relatively high PEs. So a lot of people do believe that. A low PE implies that the valuation is relatively low. So if there is some evidence which suggests that companies with relatively low valuation in the future are likely to outperform companies with relatively high valuation or with relatively high PEs, then obviously the PE is an important ratio to consider. Okay, what are the drawbacks of using the PE ratio for valuation? The obvious one is that if the earnings per share is negative, which is possible in certain quarters, it is also possible that the EPS is 0 or close to 0, then the PE would be meaningless. Earnings contain volatile transient components. As you have seen in detail in financial reporting and analysis, the earnings can be up and down. Sometimes there might be restructuring charges which bring earnings down. Sometimes there might be one-off gains which take earnings up. So one has to be careful about the fact that earnings might have components that are volatile or transient. And finally, management's choice of accounting policies may taint EPS. We won't spend much time on this because, again, this material has been covered in detail in FRA. Different companies might make different assumptions about depreciation, about operating leases versus finance leases, and a host of other items. And those different management policies and decisions will obviously impact the EPS number. How do we calculate the trailing PE? When using trailing earnings to calculate PE, the analyst must take care in determining the EPS to be used in the denominator. Specifically, here are the items to consider. And most of this should look reasonably familiar. At level 1, you might recall studying the concept of basic EPS versus diluted EPS. So if a given company reports both, and generally companies are required to report both basic EPS and diluted EPS, if you are coming up with a PE ratio, you are a financial analyst. So in the denominator, what should you use? The basic or the diluted? It makes more sense to use the diluted EPS because if you are comparing companies with different capital structures, two different companies might have, a different capital structure in terms of one company has issued convertible preferred shares, the other has not. So to bring different companies that you are comparing on the same page, to do a apples to apples comparison, it makes sense to convert, or it makes sense to use the diluted EPS. And that is emphasized in example 2, which I'll not go over because it's a really straightforward point. Next point, transitory non-recurring components of earnings that are company specific. You need to deal with these. So what should you do? If something is non-recurring, it's just there for a given quarter, and you are using your PE to compare, and obviously at the end of the day, you are concerned about what will happen in the future. So what should you do with these transitory non-recurring components? You should remove them when making comparisons. And what is the formal term for coming up with an EPS after removing these components? We generally refer to that as the adjusted EPS. This is highlighted in example 3 in the curriculum. So I want you to take a quick look at this and then I will comment. What you will notice here are several one-off charges. So a 0.06 per share charge of for restructuring, 0.07 amortization of intangibles arising from acquisitions. There's an impairment charge. So does it make sense to potentially adjust out these numbers when making forward-looking projections or when making comparisons? The answer is yes. And here is what the company has done. It has used this term called core EPS, and this is a term that you might also have seen in IFRS. This is the term you have also seen in FRA. Is core EPS an IFRS or US GAAP term? It's not. This is a term that a company is itself coming up with to try and depict its core earnings after taking out the impact of one-off items. So the company itself is reporting a core EPS over here. All right, I'm not going to go through all these details, but effectively what we are being asked to do is determine EPS and determine PE using the reported numbers as well as using the adjusted or the core EPS numbers. The calculation is fairly mechanical, and obviously you'll come up with different answers depending on which definition of EPS you use. From an exam perspective though, these are the comments on the particular example that we are just talking about, which you must master. By any of its various names, the underlying earnings or core earnings is a non-IFRS concept without prescribed rules for its calculation. So a company obviously might have an incentive to show high earnings, so it might classify items as non-recurring which are not really non-recurring. You as an analyst need to be careful about that, and specifically here is what you do. An analyst's calculations of underlying earnings may well differ from that of the company supplying the earnings numbers. Company reported core earnings may not be comparable among companies because of differing basis of calculation. Analysts should thus always carefully examine the calculation and generally should not rely on company reported core earnings numbers. So this is quite self-evident and important, hence it's been emphasized. In general, the PE that an analyst uses in valuation should reflect the analyst's judgment about the company's underlying earnings and should be calculated on a consistent basis among all stocks under review. So again, fairly self-evident and something you need to be careful about. Bottom line is, don't just take the core EPS or the underlying EPS given by the company, because every company will use its own assumptions. You should do that adjustment on your own. The next point has to do with transitory components of earnings ascribable to cyclicality. And the point here is that an economy obviously will go through cycles. Even the cycle might impact different industries differently, but in many cases you will have a situation where a company is doing well when the economy is good. In other words, the EPS will be relatively high, and when the economy is not doing well, then the EPS will be relatively low. So what do? If you are at the bottom of a cycle, should automatically the PE multiple go up because the EPS is low? Or does it really make sense to consider the cycle as a whole and maybe use an average EPS number? The answer, it does make sense to use some sort of an average EPS number. And this process of taking the average is called using the normalized EPS. Normalized earnings for cyclic companies are earnings expected under mid-cycle conditions. And there are two methods for calculating normalized EPS. So if we look at it this way, let's say that this is the business cycle, and what you can do is take a particular company and figure out the EPS during different parts of the cycle and then take the average. That is the simple historical average method. Average EPS over the most recent full cycle. The other method, which actually is theoretically more appropriate, is to use the ROE method. Here, normalized EPS is equal to the average full cycle ROE multiplied by the current book value per share. What is the book value per share? It is simply the equity of the company. Okay, so as you will see in the example which is coming up, this method better deals with the situation where a company is growing during this cycle. And also note what we are talking about here. What is ROE? It is the net income over equity. So we take the average ROE of the company, which might not be changing too much. So if a company is relatively stable, this number might be relatively stable, the net income over equity. And then if the company is growing even at a moderate rate, then what's going to happen to the book value per share over the cycle? The book value per share or the equity per share is going up. So overall the impact is still the same. You are taking this average number and multiplying by equity, so you are still getting an estimate for the net income or the EPS. So let's look at an example. So I want you to read this and then look at these numbers which are along the lines of what we are talking about, and then simplistically we are going to come up with the normalized EPS and the PE based on the normalized EPS. And we'll also use both the methods that we've just talked about. Focus on the concept. The calculation is fairly mechanical. All right, so hopefully you've gone through this and it's fairly straightforward. Averaging EPS over the entire period, so these are the EPS numbers that you just saw, divided by 7 because we have 7 years in this period. This is 0.43. So using the historical method, your average EPS is 0.43, and then the PE will simply be the stock price over 0.43, which is this. The average ROE can also be calculated because your ROE in each year is given. That average number is 16.39 based on the current book value per share of 3.43. So notice that is at the end of 2007, the book value per share is given. So you take the average ROE number and multiply by the book value per share, and you get 0.55 as your EPS. Notice this number is higher than what you had earlier, and therefore the PE number is going to be lower. And then from a testability perspective, this is important, the distinction between the two methods. Over this period, the book value per share increased from 1.58 to 3.34, an increase of about 111%. So the company obviously grew a lot. The estimate of normalized EPS of 0.55, which we have over here, from the average ROE method reflects the use of information on the current size of the company better than does the 0.43, which is calculated using the historical average EPS method. Because of that difference, the company, TSM, appears to be more conservatively valued when the method based on average ROE is used. All right, next point. Differences in accounting methods. What are we doing over here? So I'm back to this course slide where we are talking about calculating the trailing PE, and the point being emphasized is that it's not just simply a matter of taking the price and dividing by earnings over the last 4 quarters. There are several things that you need to consider. So now we are talking about differences in accounting methods. This obviously is particularly important when you are comparing different companies. So if one company uses LIFO, another company uses FIFO, obviously you need to make an adjustment. And I won't spend much time on this because in FRA we've talked about all sorts of differences between IFRS and US GAAP, and the fact that you need to bring both companies to the same standard, make adjustments so that you can compare. What do you do if the earnings are extremely low, zero, or negative? Then obviously this method doesn't work too well. When your earnings number is low or negative, then it makes sense to look at some of the other ratios that we will talk about. And here is a quick summary of the other ratios. We've already talked about the PE. At times, in fact, quite often, we also look at the inverse of these ratios. What's the inverse of the PE ratio? It is the earnings yield, or E over P. What does the earnings yield tell you? It tells you the earnings per dollar of price. Okay, when you buy something for $10, that's the share price, and the earnings is 1. So your earnings yield is 10%. And both these forms are commonly used. Then the other ratios that we'll talk about, price to book is the price per share divided by book value per share. The inverse is obviously B over P. Price to sales, inverse is sales over price. So you can read all these, they are fairly self-evident. We've talked about the trailing PE. Now let's come to the forward PE ratio. The forward PE is a major and logical alternative to the trailing PE because valuation is naturally forward-looking. In the definition of forward PE, analysts must interpret next year's expected earnings as EPS for either the next 4 quarters or the next 12 months or the next fiscal year. The point being that just because you are given a forward PE number doesn't mean you know exactly what the definition of forward is. So when you are presenting a forward PE, you need to clearly explain what is meant by forward. Is it the next 4 quarters, the next 12 months, or the next fiscal year? So when presenting, you need to clearly present what the forward number is. If you are absorbing or reading that information based on what somebody else has given you, you need to understand the underlying definition. And that is highlighted over the next couple of examples. So let's look at this one very quickly. This is easy, and then the next one is a little more complicated. So this is straightforward. What is the forward PE? You are asked to calculate the forward PE based on the fiscal year definition for fiscal year 1. What's fiscal year 1? It is 2008. So you take the stock price, which is given right here, divide by the EPS for the fiscal year 1, and you come up with 14.8. When you take fiscal year 2, then you need to take the EPS or the estimated EPS for fiscal year 2, which is 9.59. So the stock price doesn't change, obviously, but the denominator changes. So you have a different PE. Now this is an excerpt from example 6. In the curriculum, a lot is written, but what I'll try and do in many of these examples is just present the most relevant excerpt from the example. So I want you to try and do this. This is the date, 21st November 2007, and the information is presented right here. So notice that if this is the date, 21st November 2007, so you are in the 4th quarter of calendar year 2007. And fortunately for us, the calendar year and the fiscal year is the same for this particular company. We are somewhere here, so late November. All previous quarters in 2007, quarter ending 31st March, 30th June and 30th September. These are actual numbers. And then this quarter is where we are, the fourth quarter of 2007. Here we have an estimated number because the quarter isn't over, so the number hasn't been reported. And then this is the next fiscal year, also the next calendar year, and we are given the estimates for all 4 quarters. So there can be several definitions of the forward EPS. One definition would be based on the next 4 quarters. What is NTM? Next 12 months. Then you can have a definition based on fiscal year 2007, which is nearly over but not yet over. So this would also classify as a forward PE. Or you could have a PE based on fiscal year 08, right? So what are the 4 different PEs over here? I want you to quickly see if you can calculate them. It should be easy. All right, so here are the answers. The question actually asks you to calculate the PE, but the price is given. So actually the real point underlying this is to come up with the EPS for these 4 scenarios. So that's what I'm focusing on. When we say next 4 quarters, we also mean the current quarter. That is the convention. So because the current quarter's numbers have not yet been reported. So for item 1 over here, you simply take the next 4 quarters, starting with the current quarter, and take the next 3 quarters, and you come up with an estimated EPS of 0.07. Then next 12 months, here is the convention. What you do with next 12 months is, for the current fiscal year, there is just 1 month left. So you take the overall estimate for the full year and multiply that by 1 over 12. Then you take the estimate for the next year and multiply it by 11 over 12. And that gives you a fairly different EPS number. Then the third one is estimate based on fiscal year definition and current fiscal year. The curriculum makes this slightly complicated when you look at their explanation, but if we are saying the definition is fiscal year 07, then just take the fiscal year 07 number, minus 0.56. And finally, estimated EPS based on fiscal year 08, there you simply take 0.3. So once you understand what's going on, it is straightforward, but look at how this has evolved since level 1. At level 1, you just said, okay, it's the EPS in the future, but now you recognize that it's important to understand the exact definition of the future in this context. All right, we've talked about valuation based on comparables. We've talked about the definition of EPS. Now let's talk about valuation based on forecasted fundamentals. This is an important little excerpt from the curriculum which I'll read for you. The analyst who understands DCF valuation models can use them not only in developing an estimate of the justified PE for a stock, but also gain insight into possible sources of valuation differences when the method of comparables is used. Linking PEs to a DCF model helps us address what value the market should place on $1 of EPS when we are given a particular set of expectations about the company's profitability, growth, and cost of capital. So we are now going to look at the simplest of all DCF models, which is the Gordon growth model or the constant growth model, and see how that model can be used to come up with the PE. And this is something that you also covered in previous readings, so hopefully this is not an issue. You recall from before that the price of a share based on the Gordon growth model, and assuming obviously constant growth, is equal to D1 over R minus G. All we are doing now is coming up with a multiple. So if you divide this by E1 and this by E1, then what do you have? You have the leading PE ratio is equal to the payout ratio divided by R minus G. And if B is the retention ratio, then instead of payout ratio, you can write 1 minus B, which is what's given over here. So notice that here the PE is based on the fundamentals of the company. It's based on 1 minus B, which is the payout ratio. R depends on the riskiness of the company, and G depends on the growth rate. So based on fundamentals. What about the trailing PE? That is given by this expression over here, and you can see the algebra. You've also done this before. And again, I'll emphasize a point that I made in an earlier lecture. If G is positive, in other words, you have a growing company, then the trailing PE should be higher than the leading PE. All right, here are a couple of quick examples. You are given some information, and based on that information, you can easily calculate the PE based on fundamentals. So this is example 7, this is example 8. I want you to read example 8, which seems simple, but there is something slightly tricky that I'll emphasize after you have gone through this. Okay, so now here's an important point. What is Toyota's PE based on forecasted fundamentals? This is now the justified PE, or what is the PE that is justified based on the fundamentals? Are we given the PE based on market price? So if you look at the numbers given, you are told that the market price is 5480. And are we given the FCFE? So you use an FCFE model, and based on FCFE, the value is 6122. And what else are you given? Are you given the EPS? You are given the EPS of 580. So there are two different PEs you have over here. One PE is where you take the market price and divide by 580. You also have a multiple where you take the value and divide by 580. When you take the value and divide by 580, this gives you the justified multiple, because this is the number that is justified based on the fundamentals of the company. So when you take this number and come up with the multiple, that is called the multiple which is justified based on the fundamentals. If you take this number and divide by the EPS, this number is the market price. So this is the actual PE. So which multiple will be higher? The PE, the justified PE will be higher. All right, now all this second point is saying is that there are two ways of expressing whether a company is overvalued or undervalued. The very basic way is to say that, look, actual market price is 5480. When I do an analysis based on fundamentals, I come up with a value of 6122. So this company, the market price appears to be undervalued. Okay. Can you make the same conclusion looking at the PEs? The point being emphasized in this example is that stating in terms of PEs or stating in terms of actual prices, there are two ways of doing the same thing. They are equivalent. So if you say that the justified fundamentals based PE is high relative to the actual market PE, then that also implies that the stock is undervalued in the market. So that is the point being made. All right, so we've talked about a comparison-based method for coming up with PEs. We've talked about a fundamentals-based method. Now, this is a third method which connects with regression, something that you've studied in quant. Predicted PE based on cross-sectional regression. This might seem a little different from everything else in this reading, but it is mentioned explicitly in the learning objectives, and hence I am covering it. A predicted PE is conceptually similar to a justified PE and can be estimated from cross-sectional regressions of PE on the fundamentals believed to derive security valuation. This might seem a little complicated, but at least what you need to know is not particularly complicated, and it's illustrated in example 9. You are valuing a food company with a beta of 0.9, a payout ratio of 0.45, and an earnings growth rate of 8%. So you are given the fundamentals of your particular target company, which you are valuing. The estimated regression of a group of other stocks in the same industry is given by this equation. So just imagine that some researcher has done the following for you. They have taken a bunch of comparable companies, peer companies, and run a regression that looks at what the predicted PE is based on certain fundamental factors. They run the regression and they give you this particular regression equation. Will this equation be the same for every industry? No, obviously the coefficients will be different. Maybe the value drivers also might be different depending on the industry, but in your context, for your relevant industry, you are given this equation. Then how do you come up with the predicted PE for your particular entity, your particular target company? Just plug and play, right? You've done this in quant. So you take the numbers given, plug them in, and you will get your answer. So when you plug in the numbers, this is what you get. If the actual PE in the market is 18, then is this stock overvalued or undervalued? The stock clearly appears to be overvalued. And this question about whether the stock is overvalued, undervalued, this keeps coming up. It's very straightforward. So you need to be on top of this particular sort of question. You also need to understand the limitations of this method. The first one is that such models capture valuation relationships for a specific time period. The predictive power in another time period is not known. This is a classic regression issue. When you run a regression, let's say you ran this regression for the last 2 years. Does that mean that the relationships over the last 2 years will hold in the future? Not necessarily. Regression coefficients and explanatory power of regression tends to change substantially over time. So these are classic regression issues. And one that you might recall from quant is multicollinearity. What does multicollinearity mean? This means that the independent variables might have a correlation with each other. So in a regression context, if independent variables have a linear correlation with each other, then that is bad. In other words, you cannot then trust the regression. So if you think about this exercise, what are the independent variables? Dividend payout ratio, beta, growth. Do you think there is any sort of a relationship between the payout ratio and growth rates? There might be. So a big issue with such models is that of multicollinearity. Now we talk about valuation based on comparables. Here is the process that you follow. Select and calculate the price multiple that will be used in the comparison. In other words, if you decide that you are going to use PE, and let's talk about PE because that's what we've been focused on so far. So you select this multiple. It could be another multiple, but we are going with PE. And you also calculate this multiple for your target company. Then the next step is select the comparison asset or assets and calculate the value of the multiple for the comparison assets. For a group of comparison assets, calculate the median or mean. and this is called the benchmark value. Very simplistically, if we go back to the auto example that I keep referring to, your target company is, let's say, Toyota, right? So this is your target company. You identify the other major auto companies that would be classified as peer companies similar to Toyota. You come up with the PE for each of these companies, and then you come up with the average PE or the median PE. Let's say that median PE is 10. This 10 then is called the benchmark value of the PE, because you will be benchmarking or comparing the PE of your target company with the PE of these comparables. Next, use the benchmark value of the multiple, possibly subjectively adjusted for differences in fundamentals, to estimate the value of a company's stock. And this is what I started the lecture with. Let's say that for your target company, the PE is 5. You probably also have, or you should also have, the earnings number, right? So if the earnings number is 5 and based on the comparables, the PE is 10, then what is the value based on comparison? The value based on comparison is 5 times 10, which is 50. Or you can also compare the PE of 10 with the PE that you have of your target company to determine whether your target company is overvalued or undervalued. When feasible, assess whether differences between the estimated value of the company's stock and the current price of the company's stock are explained by differences in the fundamental determinants of the price multiple, and modify conclusions about relative valuation accordingly. So this is an important point. The method of comparables is based on the law of one price. The law of one price says that if all else is equal, then two items should have the same price, but all else is not equal. In the context of valuation, it is the fundamentals that might vary from one company to another company. And one of the most important fundamentals is the growth rate. So that might explain a difference in valuation. Other fundamentals might include different capital structures. If one company is more heavily leveraged, then it is more risky. So it should then possibly have a different valuation multiple. All right, so obviously, in this method, a critical element is the comparables. So what are the types of comparables that you use? One is the average or median value of the PE for the company's peer group of companies within an industry, including an average past value of the PE for the stock relative to its peer group. So all this is saying is that you take the average PE of companies in the industry or comparable companies. Average or median value of the PE for the company's overall industry or sector. So rather than just picking some companies from the industry, just having a well-defined peer group, you take a number for the overall industry or sector, including an average past value of the PE for the stock relative to the industry or sector. And then you can also take a PE for a representative equity index, including an average past value of the PE for the stock relative to the index. At times you might just want to compare with the index. A relatively straightforward example is this one, number 12. I'll not cover it, but you can read it if you have time. And finally, you can also compare the PE of a stock, the current PE, with historical numbers or historical values of the PE for the same stock. So this essentially is a time series analysis. All right, next point. Subject company multiple versus benchmark multiple. So remember, the benchmark multiple mostly is coming from comparable companies or the industry. In analyzing differences between the subject company's multiple and the benchmark value of the multiple, financial ratio analysis serves as a useful tool. Financial ratios can point out several things, and again, these are items that you've also seen in FRA, but the core point is this. If your target company has a multiple of 15, so the PE is 15, and it turns out that the PE for the benchmark is only 12, do you immediately say that for our target company which has a higher PE, it is overvalued? Not necessarily. You can look at several ratios to see whether this difference is justified or not. You can look at a company's ability to meet short-term financial obligations. If the company's liquidity ratio on average is better than the industry, would that justify a higher multiple? Probably. The efficiency with which assets are being used to generate sales. If you take a company like Dell and you compare Dell's efficiency with its competitors, is Dell more efficient? It is generally considered to be more efficient. So does that mean that Dell should have the same multiple, or is a different multiple at times justified? So that is the point made over here. You can easily read through these bullet points, but this is a connection, or this is a link between FRA and equity, which is extremely important. All right, I want you to quickly take a look at this, and there's a fair amount of text, but the underlying essence behind this example is straightforward. Read it and then I'll highlight the critical points. So let's look at the main points here. The first one is the choice of the benchmark. In our earlier discussion, we have said that the benchmark could be the industry mean or it could be the median. So in this industry, we have a very high mean number and a reasonable looking median number. So what do you think is the appropriate benchmark, the mean or the median? Clearly here, the median makes sense, because if you look at the mean, it is heavily influenced by this huge outlier. So when you are using a benchmark, you don't want to use the mean in this context. If the mean and median are close to each other, then it might make sense. But here, clearly the appropriate benchmark is the median and not the mean. Okay, that's major point number one. Next, we are evaluating Verizon. So relative to the benchmark, is Verizon overvalued or undervalued? So we look at Verizon and we look at the PE. So given no other information about growth rates or any other factor, just purely looking at Verizon's PE of 18.3 relative to the benchmark value of 17.3, is it overvalued or undervalued? It is overvalued because these numbers are based on the actual stock price. So the actual stock price over earnings, that ratio is relatively high for Verizon. So all else equal, it appears to be overvalued. So again, all else equal, just looking at these numbers, which stocks appear to be most attractive? Generally, low PEs means that you are paying a low price per dollar of earnings. So assuming all else equal, this looks quite attractive. Quest also looks quite attractive. Windstream also looks attractive. So these stocks with relatively low PEs appear to be more attractive. Okay, now coming to another ratio which is extremely important, which is the PE to growth ratio. Before I go into the details, I'll just tell you a quick little anecdote. When I first started investing, I read a book by a Wall Street legend called Peter Lynch. So he used to write, basically the books that he wrote were for non-finance people who wanted to invest. So he gave several pieces of good advice, but one important advice that stuck in my head back then was that to decide what company to buy, what not to buy, what stock to buy, what not to buy, an important thing to look at is the price to earnings ratio of a company and to compare it with the growth rate of a company. So he suggested that all else equal, and simplistically put, if the growth rate is high relative to the PE, then generally those stocks are good buys. Okay, obviously there's a lot more, but he gave the simple piece of advice. Now he didn't use this term called the PEG ratio, but effectively that's what he was talking about. Now let's look at the PEG ratio. It's the PE divided by growth. So it's calculated as the stock's PE divided by the expected earnings growth rate in percent. The ratio in effect is a calculation of the stock's PE per percentage point of expected growth. Stocks with lower pegs are more attractive than stocks with higher pegs. So if you look at the PE to growth rate ratio, if the growth rate is high but the PE is low, then obviously the peg will be low. So low peg is a positive. That gives you the basic idea, and if you have any confusion, just think about numbers. If a given stock has a PE of 10, that means you are paying $10 per dollar of earnings, but this stock is growing at 25%, then clearly all else equal this appears attractive. But what are some of the limitations associated with the ratio? PEG assumes a linear relationship between PE and growth. The model for PE in terms of the DDM shows that in theory the relationship is not linear. So what does that mean? If you look at the PE ratio based on fundamentals, what is this equal to? It's the payout ratio divided by R minus G. When you look at this ratio, while we do say that a high growth rate should mean a high PE, but is the relationship between PE and growth linear? It's not. Whereas PEG ratio sort of assumes that it is. PEG does not factor in differences in risk, an important determinant of PE. Okay, that's fairly self-evident. And finally, PEG does not account for differences in the duration of growth. For example, dividing PEs by short-term or 5-year growth forecasts may not capture differences in long-term growth prospects. Fairly self-evident. All right. Now we are going to combine our discussion of PE using comparison and going to also look at fundamentals. So if we go back to our telecom industry where we earlier looked at Verizon. So see what's going on here. You are given the same set of industries, you are given the mean and median, and we've established that it makes more sense to use the median number. But in addition to the trailing PE, we also now have the forward PE, we also have growth rates, and we also have betas. So are we given some fundamental information also, some fundamental factors? We are. Okay. Now, which stocks appear to be most attractive based on PEG and beta? So the PEG ratio actually combines two elements. It combines both the PE and the growth rate. So the PE and growth rate is both combined to give you the PEG. So in essence, the PEG does consider one fundamental factor, which is growth, but there are other factors such as the riskiness of beta. So let us now look at which stock appears to be most attractive based on these two. Which appears to be most attractive based on PEG? So if you look at Q, that appears to be most attractive based on PEG. What about this company? It also has a, I'm going to pick the three lowest PEGs. Okay, so 0.78. So these appear to be relatively good. But then you should also look at the betas. Is there a fair deviation in the betas? There is. So T has a beta of 1, which is the market average. Q has a relatively higher beta. It's a 25% higher beta. And EQIX has a very high beta. So when you take both these factors into account, then maybe something like T appears to be attractive because it has a relatively low PEG, which is good, and a relatively low beta, which is also good. The curriculum says a lot more, but what I have said here emphasizes the core point that you need to extract from this example. Okay, now some more models, and these seem cumbersome and tricky, but the underlying point is fairly straightforward. On this slide, we'll talk about the Fed model, and then on the next slide, we'll talk about something called the Yardeni model. The Fed model relates the valuation of stocks overall with the bond market. Okay, and you can read this entire text which has been taken from the curriculum, but I'll highlight the essential point. The Fed model relates the earnings yield on the S&P 500. What's the earnings yield? It is earnings over price. So on average, the earnings coming from the S&P 500 stocks divided by the price of the S&P 500 stocks as captured by the index value. All right, so this is the earnings yield. The Fed model compares the earnings yield with the yield to maturity on the 10-year US Treasury bonds. So let's just call that the yield on the relatively long-term government bonds. Now, what this model says is that the stock market is overvalued when the market's current earnings yield is less than the yield on the 10-year bond. And does that make sense? If your stock market is way overpriced, then what happens to the yield? Then the yield, earnings yield obviously is low. So according to this model, if we have a situation where the overall earnings yield is less than the yield on a 10-year government bond, then clearly the stock market is currently overvalued and should be avoided. Because when you buy stocks, are you taking risk? Obviously there is risk. Despite that risk, if your yield, expected yield on the stock market is less than the yield on a risk-free government security, then you should run away from stocks. They are way overvalued. So that is the essence of what this model is saying. All right, somewhat similar but a slightly more sophisticated model is the Yardeni model. This slide actually reproduces the entire content from the curriculum. What I'll just do is emphasize the critical points, and when you have time, I do want you to read through that one pager. So here is what the Yardeni model says. It says that the current earnings yield on the market index, which is that same E over P, according to the Yardeni model, the earnings yield should be equal to CBY, which is the current Moody's Investor Services A-rated corporate bond yield. So how is this different from the Fed model? Here, at least default risk is built in. With the Fed model, we are looking at government bonds, so there is no default risk. Now we are talking about corporate bonds, so we still don't have equity risk, but we do have default risk. So that is this yield minus a coefficient called B, which generally is, at least empirically, it has been shown that it's about 10%. It measures the weight the market gives to 5-year earnings projections, just memorize that, multiplied by the growth rate, G, plus some residual which has an expected value of 0. So simplistically, you have this expression. Now, what does this say? This is saying that the earnings yield should be equal to the yield on corporate bonds, which is CBY, minus B into long-term earnings growth rate. Okay, now what should the PE then be? So if this is what the justified earnings yield is, then what's the justified PE? The justified PE is simply equal to 1 over CBY minus B into long-term earnings growth rate. All right, just the reciprocal. Now notice that consistent with valuation theory in Yardeni's model, higher current corporate yields, so if the corporate yield is relatively high, that means interest rates are relatively high. That would mean that stock prices should be low. So a high number for the yield on corporate bonds would imply a low justified The other point is that a relatively high growth rate will imply a high PE. So in that sense, this particular model is reasonably consistent with general valuation theory, though a limitation is that it's not taking into account the equity risk premium. It is taking into account default risk because the corporate bonds do have default risk built into them, but the equity risk premium is not being taken. And then whether the stock market is overvalued, undervalued, you can use the same logic that we used in the earlier Fed model. I would not get too hung up with this material because it's not explicitly mentioned in the learning objectives, but it is emphasized in the example, so I would know at least the basics that I have covered in this lecture. All right, this is critical. Valuation relative to own historical PEs. So we've talked about valuation relative to peer companies or the industry. We've talked about valuation relative to the market. Now we talk about valuation relative to a stock's own historical PE ratios. And we look at the example of Honda Motor Company. All right. So state a benchmark value for Honda's PE. You are looking at historical data. So what should the benchmark be? Mean or median? We don't have any huge outliers, so it could be either. You can actually come up with numbers based on both. There's no hard and fast rule. Generally, one is more inclined to use the median, but you can also look at the mean. So either could be a benchmark. Given EPS for the year ended 2008, so if the EPS for the most recent year, 2008, is given, calculate and interpret a justified PE or justified price for Honda. How will you come up with a justified price? You will say that, look, this is the earnings number. If you take a median number, which makes our calculation easier, you can multiply the two and come up with the justified price. Justified based on what? Justified based on the historical PE of this particular company. And then compare that justified price with the stock price of 3590. So does the stock appear to be overvalued or undervalued if you use the median as the benchmark? Yeah, the stock appears to be a little bit overvalued. So if you actually do the calculations, with 10, you have 3305 as the justified value. If you use 10.6, then it is a little higher. So the stock's recent price is 8.6% more than the justified price. With median, it's 2.5% higher. So the stock just seems to be slightly misvalued. All right. Another point is PEs in cross-country comparison. When comparing PEs in different countries, the analyst should be aware of the following effects that may influence the comparison. The effect on EPS of differences in accounting standards, comparisons without analyst adjustments among companies preparing financial statements based on different accounting standards may be distorted. Such distortions may occur when, for example, the accounting standards differ as to permissible recognition of revenues, expenses, gains, etc. So this is classic FRA material. The effect on market-wide benchmarks or differences in their macroeconomic context. Differences in macroeconomic context may distort comparison of benchmark PE levels among companies operating in different markets. The biggest item here typically is inflation. So in the context of emerging markets, inflation is high, and that is going to impact the PE ratio. So given that inflation is a reality that keeps coming up, let us look at some interesting formulas. Assume a company with no real earnings such that its earnings growth can result only from inflation will pay out all its earnings as dividends. So based on the Gordon growth model, what is the value of the share then? So P0 is equal to E1, but E1 is simply given by E0 into 1 plus the inflation number. divided by R minus G. What is G in this context? If the only growth is coming from inflation, so you have divided by R minus I. So is this a new formula? Not quite, because you've seen this before. All you are doing is replacing growth with inflation. Suppose the company has the ability to pass on some or all inflation to its customers, and let lambda represent the percentage of inflation in costs that the company can pass on through to revenue. In other words, let's say that there is a certain inflation rate. If lambda is 80% or 0.8, then this is saying that for every dollar increase in input prices, a company can pass on 0.8 to customers. Okay, then what happens to our equation? Then we say that what does E1 become? So in this example, earlier we said E1 is equal to E naught into 1 plus I. Now, what will you have? Now you will have E naught into 1 plus lambda times I. Why? Because now at what rate is your earnings going up? Is it going up purely at the inflation rate, or it has to go up at less than the inflation rate? Less than the inflation rate based on lambda. If lambda is 0.8, then E naught is equal to 1 plus 0.8 into inflation divided by R minus G. What's your growth rate now? Is it inflation or it is actually lambda I? Okay, so same equation. Just instead of growth, you have lambda I. Now, let's introduce the real rate of return, and we'll call that rho. The value of a share and the justified PE can now be expressed as follows. So, this is P naught is equal to this expression. Now, what you can do is say the following. Actually, if you look at this, this we are writing as E1. So, this same expression can be written like this. It's P naught is equal to E1 over, or you can just bring the E1 over here, and now this is our ratio. 1 over the R minus lambda I, using some basic algebra which is shown over here, can be rewritten as the real rate plus 1 minus lambda into I. What I would say is, once in your life, you go through this algebra and convince yourself. After that, you just remember this relationship which says that the PE ratio for a company that doesn't have any real growth and can pass on lambda percent of the input inflation to customers, for that company the PE is given by this. So if you have a low real rate over here, does that create a high PE? Yes. Remember, a low interest rate means a relatively high PE. So that is given by rho. In a country with no inflation, their rho is equal to the nominal interest rate R which you use. So you can see that in this relationship. If inflation is 0, then you simply have 1 over rho, which is 1 over R. If lambda is equal to 1, then what do you have? Then you also have 1 over rho. And what's the economic justification? If a company can pass on all inflation to its customer, then should inflation impact the value of the company or the multiple? No. So that also helps you explain why you have 1 over lambda. So based on the business justification, hopefully you can memorize this formula. If you like algebra, then you can quickly derive the formula. If you like to memorize formulas, then you just box this and memorize it. Alright, now let's continue with the same example. I want to see whether you actually remember the formula we just talked about, and you compare these two companies, M and P. So let's look at part 1, A and B. if you calculate the justified PE for M, just plug in the numbers, you get 22.2. And then company P, it is similar except that the inflation number is lower. The lambda is the same, but inflation, the cost inflation is only 2%. And notice that with a lower inflation number, the justified PE is higher. So this illustrates an important point. If a company cannot pass on all inflation to customers, then clearly lower inflation is better. Lower inflation allows the company to have a higher justified PE. Then question 2 also illustrates an important point. Here, both companies face the same inflation number. Company M can pass 90%, P can only pass 70%. So which company will have a higher justified PE? Obviously the company which can pass on a higher percent. And when you do the calculations for 2A, you should get 27.8, and for 2B, what you should get is 20.8. Next point is to use PEs to obtain terminal value in dividend discount models. And this is very straightforward. It is something you've also seen in earlier readings. The first thing to do is determine the benchmark value. And for the benchmark value, you might either use the median industry PE or the average industry PE or the average of the company's own past PE. So what exactly does this mean? Let's say that you are doing a valuation at time 0 and you can predict the growth rate over the next 3 years. Let's say that this is relatively high growth. Then what do you do at year 3? We've talked about this before. What you can say is that at the end of year 3, you expect the industry PE to be a certain number. Let's say you expect that number to be 10. And say you are coming up with that number based on the median industry PE. So this 10 then becomes your benchmark. And then what do? You then say, okay, you expect the earnings over this period to be a certain number for your target company. Okay, so notice that here I'm saying trailing terminal PE. So if you are doing your valuation, your terminal value at the end of year 3, and you use earnings for year 3, which is this number over here, then you actually take the terminal PE, or this would be the trailing terminal PE, and I hope you see why it's called trailing terminal. Terminal because it's helping you come up with a terminal value. Trailing because relative to 3, you are taking a trailing PE. So obviously you will then multiply with EN. N in my example here is 3. Okay. Or if you want to come up with an estimate for year 4, but you are coming up with a valuation at the end of year 3, then you would take the forward PE, so an estimate of the forward PE, which might be say 8, and multiply that by earnings for year 4. The terminal PE can also be estimated using the Gordon growth model, and we've done this enough times. So if we do the same scenario, year 3, how do you do the Gordon growth model? If you have earnings for year 3, then what's the value here? So this would be equal to E3 into 1 plus G, because remember, value over here means that you really need the estimated earnings for year 4 divided by R minus G. And to test whether you've really understood this or not, you need to do this. You cannot pass the exam without being able to solve a question like this. So for part 1, the answer that you should come up with is 42.9. The reason is you are given E3, earnings for year 3, which is $3. And then the industry average PE is 14.3. It's not stated explicitly, but this is the trailing PE. So you multiply 14.3, the trailing PE, with 3, and you get 42.9. And then what if you use the Gordon growth model? So here is what you do for the second one. Remember that the growth rate is equal to the retention ratio, 0.55, it's 1 minus 0.45 into the ROE, so growth rate is 0.0715. The value at time 3 is equal to the dividend at time 4 over R minus G. Dividend over here for year 4 is equal to earnings for year 4, which is 3 into 1 plus the growth rate, multiplied by the payout ratio, which is 0.45, divided by R minus G, and here you should get 50.76. All right, we are done with PE finally. Now we move on to price to book value. Price to book is the price divided by book value per share. So in all these multiples, the numerator is always the current stock price. It's only the denominator which is changing. Book value per share represents, on a per share basis, the investment that common shareholders have made in the company. So how do you come up with this? You simply take the total assets minus liabilities. If a company has issued preferred shares, then should you subtract the value of preferred shares? You should, because this definition is based on common shareholder. And this should be very obvious, because what is P representing? It is the price of common shares. So the denominator also should reflect common shares. If there are any other kinds of shares, you need to subtract that impact, just the way you subtract the value of liabilities. Okay, what are the various rationales for using price to book ratios? First, if you have a situation where EPS is negative, or if EPS is extremely small or zero, you have trouble, then you can't use PE. But you can still use price to book, because for any company that you would be interested in, the book value should be positive. Also, the book value per share is more stable than EPS. Even when EPS is volatile, the book value per share is not that volatile. More useful for valuing companies with liquid assets. So for a bank, for example, with mostly liquid assets, it makes sense to value based on book value. Can be used when a company is not a going concern. So book value can be used for coming up with the liquidation value of a firm. Differences in PB may relate to differences in long run returns. We saw a similar statement when we started talking about PE ratios, and you might also recall one of the anomalies that you studied at level 1, where studies have shown that companies with relatively low price to book ratios tend to perform well in the future. And in fact, in investment related literature, this ratio has received a lot of emphasis. When we talk about value investing, the essence of value investing is to invest in companies which have a low price, a low market price relative to book value. What are the drawbacks of using this method? Assets creating value, example, human capital, are not on the balance sheet. So in our world, where the importance of human capital is increasing, if you talk about IT related companies, you talk about consulting companies, clearly book value is not a good indication of the overall value of those firms. So it does not make sense to use price to book value to value a company like McKinsey, for example. It can be misleading when companies have different levels of assets. So we are going to talk about an example of Dell Computers, where Dell and its competitors are obviously in the same business, but Dell outsources a lot. So does it make sense to use book values to compare? Not always. Accounting effects, example R&D, can compromise book value. You've seen this in FRA. You might have different companies that have a different approach towards capitalizing versus expensing. So similar companies, but if the approach towards capitalizing and expensing is different, does that impact book value? It does. BV is generally not reflective of market value. So if the book value and market value are completely different, then that also compromises this method. All right, so this is just an excerpt from example 18, which emphasizes that differences in models can be reflected in terms of different price to book ratios. If you look at the price to book of Dell computers, that ratio is 10. And when we look at the mean value for comparable PC companies, that is 5, and the median is 2.7. So purely, if you look at these numbers, does Dell appear to be overvalued or undervalued? Dell appears to be immensely overvalued because it has a very high ratio. I hope you recognize this, but in general, all else equal, a high ratio where the numerator is a price of some form, a high number means overvalued, low number would mean undervalued. So Dell appears to be very overvalued, but when you recognize the fact that Dell has a different business model where it has a just-in-time system, so it maintains low inventories, it outsources whatever activities it can. So clearly Dell would have low assets and therefore low book value and therefore a relatively high price to book. How do you determine book value per share? It's fairly straightforward. You have to first come up with the common shareholder equity and then divide by the number of common shares outstanding, because the price is on a per share basis, so the book value also has to be on a per share basis. How do you come up with shareholder equity or common equity? So you come up with shareholder equity and then also subtract any equity claims that are senior to common stock. So for example, preferred shares, any of those claims also need to be subtracted. So you are purely dealing with common equity. I'm not going to do example 19, but you can look at it if you have time. It is just a simple application of what we have talked about here. Many analysts make adjustments to reported book value. So we talked about the fact that the book value might not be totally indicative of market value. So there might be other reasons also for why an analyst just doesn't look at the balance sheet and use that book value. Some adjustments need to be made. Two major reasons are shown right here. To make the book value per share more accurately reflect the value of shareholders' investment. And number two, to make price to book more useful for making comparisons among different stocks. So if different companies are making different assumptions about capitalizing versus expensing, then obviously you have to make some adjustments before you compare. So what are some of those adjustments? A, you could exclude intangibles. Is it possible that one company has grown through acquisition and therefore has a large amount of goodwill? Another company has grown organically and therefore does not have goodwill. So the assets of the company that has grown through acquisition will be inflated because of high goodwill numbers. Would it make sense to remove all goodwill when comparing? It does. When you come up with a number after removing goodwill, that number is called the tangible book value. So more precisely, if you come up with book value looking only at tangible assets, then you have a tangible book value. Does this always make sense? Maybe, maybe not. For companies, manufacturing companies, it might make sense. If you are evaluating consulting companies, then it might be silly to use tangible book values alone. Adjustments necessary to enhance comparability, and you've seen a lot of this in FRA. So one company uses US GAAP and then inventory valuation is done using LIFO. Another company uses FIFO. So make the adjustment before comparing. Adjustments for off-balance sheet items. One company uses operating leases, the other uses financing leases. So you might want to make an adjustment there. And obviously fair value adjustments. If clearly land, property or property, plant, equipment is based on historical cost, which is way below current market value, then before comparing, you can make a reasonable fair value adjustment. If you have time, go over example 20, which talks about many of these adjustments. And if you are good with FRA, then this should be very straightforward. All right, now valuation based on forecasted fundamentals. So what does this mean? Just like you came up with a PE ratio based on fundamentals, similarly, we can come up with a price to book based on fundamentals. Now, if you are the sort of person who just likes to memorize formulas, then this is the formula for price to book. It's not a very difficult formula. It's ROE minus G over R minus G. And in order to help you remember this, R minus G is similar to what you've seen before. Do you think a company has a high price to book if the ROE is high relative to growth? Answer is yes. So that's not a precise explanation, but it might help you remember. Those who want a precise explanation can look at this derivation. It is not required that you know this, but I think it's interesting. This, I hope you remember, PE is the retention ratio, 1 minus B over R minus G. Then, how do we go from here to here? If you notice that what we've done is instead of E1, we've written ROE into B0. What's ROE? ROE is simply net income over equity, which is book value, right? Or earnings over book value. So the book value would cancel out. So E1 can simply be written as ROE times book value. Then once you buy that, then what you can have is P over B, and ROE moves up here. So what you essentially have then based on this is P over B is equal to ROE into 1 minus B over R minus G. And then this can be written as ROE into 1 minus B times ROE, which is this. Okay, and what is ROE times B, which is the retention ratio? That is simply G. So like magic, we have P over B is equal to ROE minus G over R minus G. If you want, you can learn the derivation, but I would say that once you are convinced, just remember this relationship. All right, now just to make you do some quick work, use that relationship and come up with what the justified price to book should be for this firm. So this is a straightforward calculation, but again, I'll emphasize that obviously it is looking simple right now. You need to remember this because there's a fair chance that this might show up on the exam. All right. Now, PB using the comparables approach. The concept is similar to what we've talked about earlier with PE. You look at a set of comparables and then you look at whether the price to book for your target company is higher or lower than the price to book for the comparables. So I want you to do this. This is a relevant excerpt from example 21. So given the data below, is MER relatively overpriced or underpriced compared to the industry and then compared to peer companies? So the first thing is compare with the industry. So you look at the price to book value of 1.5 for your target company compared to the industry. Does it appear overvalued or undervalued? So the price to book is low, so it appears to be undervalued relative to the industry. But then maybe it is undervalued because of differences in ROE. So it does have a slightly lower ROE, but if you really think about it, the price to book is substantially lower than the industry value of 2. But the ROE is only marginally lower. So we can say that based on this information, it appears that MER is relatively undervalued compared to the industry. What about compared to the peer companies? When you compare with the peer companies and just look at price to book, the price to book is in the same ballpark. Okay, it is a little bit higher than GS, but the same as MS, but roughly in the same ballpark. So then you look at the other numbers. The other two companies have a higher ROE and lower betas. So compared to these two other firms, MER looks overvalued. So notice what we are doing here. We are actually combining comparables with also looking at some fundamentals. And that's quite important. So just looking at the PB is not enough. You also need to look at other factors. Okay, this is the explanation from the curriculum. Moving on to price to sales, and I'd say this is relatively less important, but you still need to know this ratio. Certain types of privately held companies, including investment management companies and many types of companies in partnership form, have long been valued by a multiple of annual revenues. In recent decades, the ratio of price to sales has become well known as a valuation indicator for the equity of publicly traded companies as well. So it's an important ratio that you need to be aware of. What are the rationales for using price to sales? Sales are less subject to accounting manipulation than EPS or book value per share. Sales are positive even when EPS is negative. Sales are more stable than EPS. I'm not giving any explanation here because these items are fairly obvious. More useful in valuing mature, cyclical and zero income companies. And finally, differences in price to sales may relate to differences in long run returns. So all fairly straightforward. What are the drawbacks? Might have high sales growth but low earnings and CFO. This connects with FRA, like so many other things in this reading. You might have a company that is doing overly aggressive revenue recognition. Will the sales numbers be going up? Yes. And maybe earnings and CFO might not be going up. Price to sales does not capture difference in cost structures. This is blatantly obvious. You might have two companies where the sales are growing at the same rate, but one company has a high cost structure, the other has a low cost structure. So will that difference be captured in this ratio? It will not. Does not capture different capital structures. Again, that is obvious. And over here we say sales are less subject to accounting manipulation than EPS or book value, but can no manipulation happen? That's not true either. Different companies, as we've seen before, can have slightly different revenue recognition practices, and that obviously will impact sales. How do we calculate this number? It is obvious. Total sales divided by the number of common shares outstanding. And as I mentioned before, as an analyst, if you are using this ratio, you need to have a good understanding of the revenue recognition policies being used, especially if you are comparing different companies. Valuation based on fundamentals. This is the formula to remember, but where is it coming from? This, I hope, is familiar by now. So PE is simply, this is the trailing PE. The trailing PE, this is the payout ratio actually. So it's the payout ratio into 1 plus G over R minus G. Then what are we doing? If you move E naught over here, so the E naught comes here, and then divide both sides of the equation by sales. Then on the left you have price over sales, and on the right, what is this? Earnings over sales. This is the net profit margin. And knowing the CFA Institute, anytime you see the net profit margin or something like that, they might imply that either you just come up with this or they also have thrown in DuPont. So if you know all the other parts of DuPont, you can come up with net profit margin. But this is the formula. I think this is extremely straightforward, hence I'll not go over all these examples. If you have time, you should do so. In example 22, you see how to simply calculate the price over sales. Then 23, 24, 25 talks about revenue recognition practices, which could easily also be part of your FRA material. 26 talks about the justified PS based on forecasted fundamentals. You are given these fundamentals, you plug and play and come up with PS. And then PS based on the comparables approach. What do you think happens there? Is all else equal, is a high ratio good or low ratio good? As with all other ratios where P is in the numerator, a low ratio means that the stock is relatively undervalued. Price to cash flow. Price to cash flow is a widely reported valuation indicator. Because of the wide variety of cash flow concepts in use, the analyst should recognize the exact definition of cash flow that is the basis for the analysis. And what are the different definitions of cash flow? There are several, but some that we've looked at include CFO, FCFE, EBITDA. Some analysts simply take net income and quickly add the non-cash charge. What are the rationales? Less subject to manipulation relative to earnings, more stable generally than EPS because there is less room for assumptions and manipulation, addresses the issue of accounting differences to some extent. Differences in price to cash flow may relate to differences in long run returns. And this last bullet point you will see almost across the board, and I've already explained what this means. What are drawbacks? Earnings plus non-cash charges definition of cash flow ignores the changes in working capital. Okay, so it would be more appropriate to use FCFE, but here again, there might be some assumptions that need to be made. And an issue with FCFE is that it tends to be more volatile, and often, at least for young companies, this might be negative. Valuation can be based on forecasted fundamentals and based on comparables. Comparables is obvious. What does valuation based on forecasted fundamentals mean in this context? Fortunately, we don't have a formula to remember here, unlike the earlier ratios, but the idea is straightforward, and I'll illustrate the idea through example 30. So you are a technology analyst. The idea with a justified P to cash flow, price to cash flow based on fundamentals, is that you can come up with the value of a company based on a cash flow measure such as FCFE. Is that easy to do? You've done that before. This is from the earlier reading. Then what is the justified PE based on fundamentals? That justified PE would simply be the value that you come up with through the use of fundamentals divided by whatever measure of cash flow you are using. Since we are talking about price to cash flow, when we talk about the justified number, you don't use the market price, you use the value that is calculated based on the fundamentals. That is the fundamental point over here. So in this scenario, what is the intrinsic value? If you simply plug in the numbers, this is coming up based on formula. Calculate a justified PE. How do you do that? You take the value, which is like the V0, divided by, what's this number? This is the measure of cash flow that we are using. So the measure of cash flow here is earnings plus non-cash charges, 5.43. So you simply do that. What is the justified price to FCFE based on forecasted fundamentals? That's shown over here. So all this example is doing is also illustrating that you can have different definitions of cash flow, and obviously depending on the definition you will get a different ratio. Okay, based on comparables, if you are given this information and you are asked which company is relatively overvalued or which company is relatively undervalued, what will you say? Alright, so if we think about which stock is more attractive, in terms of price to cash flow, A has a lower price to cash flow, so that is more attractive. When you look at price to FCFE, with company B, we have a negative FCFE, so there again A is more attractive. In terms of growth rates, A has a higher growth rate, so it's more attractive, and the beta is the same. So when you look at this information, A seems better. And this is what the curriculum says, which you can also read. The final one for section 3, which is dividends. Price to dividends, which is obviously the price divided by dividends, and dividend yield. Keep in mind that dividend yield is used much more frequently than price to dividend. And you might think this is straightforward, but there are a few important items to keep in mind. First, let's talk about the rationales for using dividend yield. Dividend yield is a component of total return, and dividends are a less risky component of total return than capital appreciation. And these are the drawbacks. Dividend yield is only one component of total return. Not using all information related to expected returns is suboptimal. Investors may trade off future earnings growth to receive higher current dividends. In other words, if you as an investor demand high dividends, what are you compromising? You are compromising future growth. So holding returns on equity constant, dividends paid now displace earnings in all future periods. This is called displacement of earnings. The argument about the relative safety of dividends presupposes that market prices reflect in a biased way differences in the relative risk of the components of return. So that's considered a theoretical drawback. Okay, now you might think that calculating dividends is easy and calculating dividend yields is easy, but there are a few basic caveats. As with other ratios, you can have trailing numbers and leading numbers. Companies might pay dividends every quarter. They might pay dividends every 6 months. So let me emphasize what you need to do here. Trailing dividend yield is generally calculated by using the dividend rate divided by the current market per share. Okay. Then the question is, what's the dividend rate? The annualized amount of the most recent dividend is known as the dividend rate. So this is an important point. It's the annualized amount of the most recent dividend. For companies paying quarterly dividends, the dividend rate is calculated as 4 times the most recent quarterly per share dividend. So let's just look at example 32. If you look at company PG and you are sitting here, let's say in third quarter 2008, what's the dividend amount? So the dividend amount will be 4 times the most recent number. So it is going to be 0.4 into 4, which is 1.6. But what about this other company, UL? And again, you are sitting over here. This other company pays dividends every 6 months. And it looks like there is a big difference between the dividend. So the intermediate dividend is a small number, and then the final dividend is the big number. So there are several scenarios here. Do you just take 0.668 and times 2? That would not make sense. What you actually do over here is add these two numbers. When a company pays only 2 dividends a year and there is a difference between the two, the convention is to simply sum up those two numbers. So here you will just take the sum of the two numbers as the dividend for the other company. Remember that. The leading dividend yield is calculated as the forecasted dividends per share over the next year divided by the current market price per share. Valuation based on fundamentals and comparables. So valuation based on fundamentals is straightforward. Hopefully you remember this. What is the price of a share? The price of a share is D naught into 1 plus G over R minus G. So then instead of D naught over here, you can have D naught over here. And then what are we looking at as the dividend yield? It's simply the reciprocal of this expression. So it is R minus G over 1 plus G. And then based on comparables, is a high dividend yield good or low dividend yield good? Actually, all else equal, now a high number is good because we are talking about a reciprocal. The price is in the denominator. Unlike all other ratios that we've talked about, the price has been in the numerator. Now we are talking about a yield, so the price is in the denominator. So all else equal, if you are two companies in the same industry, same growth prospects, same risk, then which one would you prefer? The one with the higher dividend yield or the lower dividend? All else equal, you would prefer a higher dividend per dollar of share price. So now based on the information presented, which stock do you prefer? And let's just look at the numbers. Consensus forecasted growth numbers. So who is looking good here? So if you pick the best two, it would be PPL and Pepco Holdings. Based on beta, who is looking the best, there you look at the low beta. Dividend yield, all else equal, you are looking at relatively high. So these are all roughly in the same ballpark. So what is the payout ratio telling you? How much percentage of earnings are paid out? So with the dividend yield, here are the companies that seem relatively high. Now looking at these numbers, it is not obvious which one is most attractive. It really, in a sense, depends on you. If you look at PPL from a growth forecast perspective, it is really attractive and the beta is relatively low. Dividend yield, as you might expect for a high growth company, is relatively low. So from this perspective, PPL seems attractive. If you are purely interested in high dividends, then this company, Progress, might appear appealing because it has the higher dividend rate, and the beta is also somewhere in between, so it's not overly risky compared to the peer companies. So bottom line is, it really depends on you over here. There is no obviously attractive company in this list. Enterprise value to EBITDA. As I'm sure you are aware, EBITDA is a flow to both debt and equity holders, because this is the money that is generated, or this is actually an amount before we subtract taxes, depreciation, amortization. So it goes to both debt holders and equity holders. Enterprise value is a value of the total company, which includes debt and equity. And this ratio, enterprise value to EBITDA, is the most widely used enterprise value multiple. Hopefully you recognize the fact that both the numerator and the denominator are taking a holistic perspective. By holistic, I mean we are covering all investors, both debt holders and equity holders. What are the rationales for using this particular multiple? The first one is that EV to EBITDA is usually more appropriate than the price earnings alone for comparing companies with different financial leverage. The second point is that by adding back depreciation and amortization, EBITDA controls for differences in depreciation and amortization among businesses. For this reason, EV to EBITDA is frequently used in the valuation of capital-intensive businesses. And finally, EBITDA is frequently positive even when EPS is negative. You need to remember these reasons, and they are fairly straightforward. What are the drawbacks? EBITDA will overestimate cash flow from operations if working capital is growing. And hopefully you recognize this. If working capital is growing, what does that do to cash? It is a use of cash. Is that use of cash captured in the income statement? It is not. So since that use of cash is not being captured in the income statement, EBITDA, which is an income statement item, will be overstated. EBITDA also ignores the effect of differences in revenue recognition policy or cash flow from operations. The point being that if you are comparing different companies which are similar in all respects but have different revenue recognition practices, then obviously EBITDA, which starts with sales, will be different. Free cash flow to the firm, which directly reflects the amount of the company's required capital expenditures, has a stronger link to valuation theory than does EBITDA. Only if depreciation expenses match capital expenditures do we expect EBITDA to reflect differences in businesses' capital programs. So all this point is saying is, theoretically FCFF is better than EBITDA in the denominator, but EBITDA is much easier to come up with, so you will very often see this multiple being used. In fact, as has been mentioned up here, in the real world, in practice, EV to EBITDA is easily the most commonly used enterprise value multiple. So how do we estimate enterprise value? This is a formula that you saw at level 1 and you've seen again earlier in curriculum, the enterprise value for a firm, or the enterprise value, is the market value of common equity plus the market value of preferred stock plus the market value of debt less any cash and investment. So marketable securities that are not directly part of the operations of the company need to be subtracted to come up with enterprise value. The curriculum gives a long example, example 34, which describes this calculation. And if you have time, you can go through the example, but here is the relevant excerpt. We are given a company and we are given the balance sheet and more information. And from that balance sheet and the additional information provided, we first come up with enterprise value. And how do we do this? This is the market value of equity. We are given the stock price, and from the balance sheet, we are given the number of shares outstanding. So we multiply the two and come up with this number. This is the market value of debt. And if the market value of debt is not easily known, then you often use the value of debt from the balance sheet as a proxy. If you know both, if you know the market value of debt and the book value, then what should you use? Then you should use the market value. If you don't know it, then your best assumption is that the book value represents the market value of debt. And then 949 is the value of short-term investments. So you subtract that number and come up with enterprise value. Then for the denominator, which is EBITDA, you use the trailing 12 months, and we don't need to get into the details, but essentially this is the number 1479. So what is the multiple? The multiple is 7004 divided by 1479. This will give you your EV to EBITDA multiple. Valuation based on forecasted fundamentals and comparables. So let's talk about forecasted fundamentals first. Justified EV to EBITDA is arrived at by dividing the enterprise value of a company based on a valuation model such as FCFF by the company's actual or forecasted EBITDA. All this is saying is that to come up with the multiple EV to EBITDA, you have to come up with the enterprise value. And this is saying that you arrive at the enterprise value using a model such as the FCFF model. So take a very simple company that does not have any marketable securities, just for simplicity, or marketable securities are close to zero. What is the enterprise value? Assuming Gordon growth, assuming that a company is growing at some sustainable rate, the free cash flows are growing at some sustainable rate, the enterprise value will be FCFF at the end of 1 year divided by WACC minus G. So what does this give you? Does this give you the market price, or does this give you what you believe the value should be? This gives you what you believe the value should be. So when we talk about the justified multiple based on fundamentals, it is simply this enterprise value that you have calculated using your fundamentals, the FCFF, WACC, G, etc. And then you divide the number that you get by EBITDA. So it is very straightforward. How is this different from taking the market value of debt, market value of equity, and then dividing by EBITDA? That would be the actual multiple based on market prices. So if you have the actual multiple based on market prices and you have this multiple, you can compare the two multiples to figure out whether the company is overvalued, undervalued. If the market multiple is low relative to this justified number, then the security or the company is attractive. All right, now the justified EV to EBITDA is positively correlated to expected growth rate in FCFF. What does this mean? This is a standard concept that we've discussed before. If the growth rate is relatively high, then what will happen to the justified multiple? The justified multiple will be relatively high. and negatively correlated with the cost of capital. So if the cost of capital is relatively low, then obviously our multiple will be high. Again, this is the justified multiple, the multiple justified based on the fundamentals. Valuation based on comparables. How do you do this? We'll see this in an example on the next slide, but you take a group of peer companies or you take the industry, you come up with the benchmark value for EV to EBITDA and compare that benchmark value with the multiple for the company that you are analyzing. If the company that you are analyzing has a low multiple relative to the industry or the peer companies, then that means that this company is probably attractive, all else equal. So this is an excerpt from example 35, which illustrates what I am talking about. Just a few points that I want to highlight. These are the various peer companies that we are looking at, and the example gives us several pieces of information: the price, shares outstanding, market cap. There are some items that might not explicitly be mentioned in the learning objectives, but I think you should still know these items. So notice this term, total invested capital, TIC, and enterprise value. I want you to stare at this data. And I know you've not seen TIC before, but based on looking at the information presented, think about what's the difference between TIC and enterprise value. The only difference is this cash item. So with TIC, we do not subtract the value of cash and marketable securities. If cash and marketable securities are a small number relative to debt and equity, then TIC and EV will be roughly the same. All right, now, next what I want you to do is look at these multiples and ratios and come up with whether WDC is an attractive investment or not. So if you look at the numbers, let's start with the most important ratio, at least in the context of what we are studying, which is EV to EBITDA. As we've said, all else equal, a low number means that the security is attractive. So this is selling, or this is at a relatively low multiple compared to this company and this company. But it is higher than STX. So purely based on EV to EBITDA, STX seems to be better. What about based on total invested capital to EBITDA? There also STX seems to be better, even though WDC is better than these two companies in the middle. Return on invested capital, this is an important measure. Return on invested capital is NOPAT, net operating profit after tax, divided by the invested capital. So obviously, the higher the better, all else equal. Here with this ratio, again, this company, STX, seems better. But when you look at the debt to equity ratio, the debt to equity ratio for STX is more than twice the debt to equity ratio of WDC. So while STX does seem to have more attractive multiples and a better ROIC, but it also appears to be a lot more leveraged, so probably more risky. And then if you look at the growth rates, the quarterly growth rate, 49.7% for WDC. So absent any other information, this looks very attractive relative to the other options over here. So all in all, WDC seems definitely better than NTAP and EMC. And there is some debate as to whether WDC is better than STX. In some ways, STX looks better. In other ways, WDC seems better. Our conclusion is that we need to look further into WDC and STX. All right, some other enterprise value multiples. So if you look over here, the item that we have focused on is EBITDA. All we are looking at is alternative denominators. What is the numerator? The numerator we are assuming is EV. So what do you have in the denominator? The other possibilities are FCFF, which theoretically is appealing, but at times might be complicated to calculate, EBITDA and EBIT. And these are definitions that you know. Just be aware that if you see another denominator, then you should not be frazzled. Other denominators can be used. All right, next point. Enterprise value to sales. This is a short segment. I don't think it's overly important. I'll just read the little paragraph from the curriculum and highlight what you need to know. Enterprise value to sales is a major alternative to the price to sales ratio. Do you remember this ratio? We talked about this earlier with the PE ratio and price to book. But there's a fundamental issue with price to sales. The price to sales multiple has the conceptual weakness that it fails to recognize that for a debt finance company, not all sales belong to equity investors. So the P is the price of a stock. So this obviously is a common stock or equity holder perspective. But the S is not purely an equity holder perspective, because the sales, in a sense, first go to debt holders. Once they are paid off, then the shareholders get their part after that, after the expenses have been paid off. Some of the proceeds from the company's sales will be used to pay interest and principal to the providers of the company's debt capital. For example, a price to sales for a company with little or no debt would not be comparable to a price to sales for a company that is largely financed with debt. Enterprise value to sales would be the basis for a valid comparison in such a case. In summary, enterprise value to sales is an alternative sales-based ratio that is particularly useful when comparing companies with diverse capital structures. And this is illustrated in example 36. I'll not be doing it, but if you have time, you can review this example. So this is not testable. It is basically general knowledge. You can take a quick look at this. All you have here is different sectors or different industries, and you are given the PE ratios and some other fundamental statistics for different US-based industries. Section 5 is a short little segment on international considerations when using multiples, and most of this is something you probably know already. Using relative valuation methods in an international setting is difficult for several reasons. And what do we mean by this? The point here is that if you are comparing a textile company in South Asia with a textile company in North America, it is not that easy to just start comparing the price to earnings ratios or price to book value ratios. Why? One basic reason would be differences in accounting methods. And we've done this over and over. Level 1 FRA, level 2 FRA. If companies in different parts of the world are using different accounting standards, then any accounting related measure such as earnings or EBITDA or book value is going to be influenced by the accounting standard being used. Having said that, ratios such as price to cash flow, be it CFO or be it FCFE, would be relatively less impacted by accounting differences. Another point has to do with cultural differences. If a country by and large tends to be more risk averse, that is going to impact stock valuations, which will then also impact the multiples. Economic differences can have a huge impact. If a given part of the world is experiencing a tremendous amount of growth, then obviously, fundamentals such as G and cost of capital and so on will be very different from other parts of the world which have a different economic situation. So bottom line is that you need to think real hard before simply comparing ratios for companies that are operating in different parts of the world. Next point, or next section, momentum valuation indicators. You might recall a reading in level 1 quant called technical analysis, and this is essentially an excerpt or taken from that particular reading. So this is technical analysis in the context of multiples. Fortunately for us, this is not a very long section, and we simply cover 3 representative momentum indicators. The reason we are saying 3 representative indicators is there are lots of indicators. We are just going to talk about 3 of them. One is earnings surprise, then standardized unexpected earnings, and relative strength. So what does earnings surprise mean? If you are studying a given stock, any publicly listed company is obviously going to have periods where they announce their earnings for a quarter that has just completed. And analysts are typically following that company, so analysts have expectations about what the earnings number will be. There is this number called the consensus estimate, which you can think of as the rough average of the various estimates. So that is the expected value of the earnings per share. When the company actually announces the earnings per share, it is possible that the earnings per share number is different from what is expected. So if analysts are expecting $1 per share and what actually is announced is 1.05, then what is the earnings surprise or the unexpected earnings? It's 1.05 minus 1, which is 0.05 cents per share. Related to this measure is something called scaled earnings surprise. So is this 0.05 surprise a big deal or not? One way of figuring that out is to take the unexpected earnings or the earnings surprise number and divide by the standard deviation of the analyst's forecasts. A simple example is given here, number 37. You have a given company and the mean consensus forecast is 1.53. Then the actual EPS turns out to be 2.4. There are several analysts who are following this stock, and the standard deviation of the analyst's expectations is equal to 0.28. The scaled earnings surprise is 3.11. So this is going to be the difference, 2.4 minus 1.53 divided by the 0.28. So notice that if there is a large standard deviation, which means that the different analysts are spread across a wide range, then a number that is different from 1.53 is not that unexpected. Another measure which is referenced more often is the standardized unexpected earnings, or SUE. Now what is this? The numerator should look familiar. This is again the EPS that is actually announced minus the expected value of the EPS. But this is now divided by the standard deviation of past unexpected earnings over some historical period. So you might have a period of say 2 years, and over those 2 years you look at all the unexpected earnings for this particular company. It might be that last quarter the unexpected earnings was 0.05, the quarter before that the unexpected earnings was 1, before that the unexpected earnings was 0.10, and so on. So you take a certain period, let's say 2 years, and you find the standard deviation of the unexpected earnings over that period. If you have a company where the standard deviation of these unexpected earnings is very low, that means that for this particular company, historically, the earnings number that is announced is typically close to the earnings number that had been forecasted in the past. So if that company has an earnings surprise, it's a much bigger deal relative to a company that has a history of having earnings surprises. So that is captured by this measure. You might be wondering why we are talking about this. What is the rationale for worrying about earnings surprises? there is some evidence, some empirical evidence that positive earnings surprises may be associated with persistent positive abnormal returns or alpha. And you might recall this as one of the anomalies that you studied at level 1. Typically, companies that have a positive earnings surprise, at least in the short run, tend to perform well. So one possible trading strategy is to buy stocks which have just announced an earnings number which is higher than what was expected. So buy stocks which have positive earnings surprises. So this is example 38, which illustrates the unexpected earnings for two companies. So we have Sony and Philips. I want you to look at these numbers. So we have, several quarters of data. If you look at the most recent quarter for Sony, what was the consensus EPS forecast? Minus 6.3. What was the actual EPS? 28.9. What is the percentage earnings surprise? Where does this number come from? This huge number. This is the earnings surprise, which is the difference, divided by the forecast. What does this standard deviation of 8.34 mean? This is the standard deviation of earnings surprises in the past for that same company. Alright, so a relatively high standard deviation number means that this company has a history of relatively high earnings surprises. Now, where does this number 4.22 come from? And I want you to calculate this before looking at the solution. So to come up with 4.25, what we say is the actual EPS 28.95 minus 6.3, which becomes a plus, divided by standard deviation, and that will give you this particular number. So that answers our first question. Then the next question is, based on these exhibits, for which company were the consensus forecasts less accurate over the past 4 quarters? If you look at the SUE score for Sony, you have a large number, 4 point something and 4 point something over here. But for Philips, the numbers are generally 1 or less, like it's minus 1, 0.7. So it is in a much narrower range. So what this means is that the earnings surprises were far greater with Sony. The next question is, interpret the amounts of the percent surprise and why are the signs different over here? So why do we have a minus for percent surprise whereas a positive for the score? This has to do with the definition of this percent surprise. Percent surprise is the surprise divided by the forecasted EPS. The surprise itself is positive because the actual EPS is greater than the forecasted number. So the actual EPS is actually much greater. So how do you calculate this surprise? It is the actual surprise, which is a positive number over here, divided by the forecast, which was a negative number. That's why the percent surprise is negative. The SUE score is positive because this is the surprise, which again is positive, divided by the standard deviation, which has to be positive. If you look at this number over here, why is this negative for the SUE score? This is negative because in the quarter that we are talking about, the surprise is negative. The actual turned out to be less than what was forecasted. Surprise is negative divided by standard deviation, which has to be positive. You get a minus SUE score. The percent surprise is negative. Why? Because you have a surprise which is negative divided by the forecast, which in this case is positive. The third measure we'll talk about is relative strength. Relative strength indicators compare a stock's performance during a particular period to its own past performance or to the performance of some group of stocks. So you can have a price momentum indicator which compares a stock's performance during a period with its past performance. If a stock in the past has been growing on average at 8% and now it is suddenly growing at 12%, we'll say that it has strong momentum. Something that is used more often is you look at the performance of a stock or a sector relative to an index. So generally it is with a particular stock. You look at the stock's performance divided by the performance of an equity index, and this is easier understood visually. If you are in a market, let's say you are in the US market, and the S&P 500, which is a major index, is going up slowly, but a particular stock is going up at a much faster rate, then the rate of growth of the stock divided by the growth rate of the S&P 500 will be more than 1. And that would indicate the fact that the relative strength of this stock is positive or strong. So what is the rationale for relative strength? Patterns of persistence or reversal exist in stock markets. Now, this is the underlying theme behind technical analysis, that if a particular stock is performing very well, at least for the short term, there'll be some pattern, or in the short term, it will continue to perform well. But also note that investing strategies based purely on technical momentum indicators are inherently self-destructing. What that means is, if everybody in the market knows that this particular stock is going to do well, what will happen? Automatically people will buy, the stock price will go up, and it will no longer be a valuable stock to buy. So it will no longer be attractively priced. So practically speaking, how do practitioners operate? What practitioners do is they often use fundamental analysis, and then in addition they might use technical analysis to see what is the momentum. Is the momentum positive or not? The final section in this long reading, some issues in practice. Some issues that arise in practice when averages are used to estimate benchmark multiples include the following. What definition of mean to use? And another issue is one that you have memorized maybe or heard of at level 1, called look-ahead bias, and here we'll actually understand what this means. Now, to set the context here with what definition of mean, this is important because when we talk about the PE multiple of a given stock, then we say that the stock is overvalued or undervalued relative to the PE of a benchmark. The benchmark would be maybe the average of the PE of a bunch of representative stocks. So what average do you use? Should you use the weighted average, the geometric average, a plane average, a harmonic mean? So what average to use? And the answer is that the most theoretically appropriate mean to use when you are coming up with a mean of a ratio such as PE is the weighted harmonic mean, and we'll see why. Analysts often apply the weighted harmonic mean to average a group of price multiples. And in the example that I'm going to show you from the curriculum, the weighted harmonic mean precisely corresponds to the portfolio PE of 12.9. So where are these numbers coming from? To illustrate the point, the curriculum identifies a very simple portfolio of two stocks, stock 1 and stock 2. The market cap of stock 1 is 715, market cap of stock 2 is 585, and then in your portfolio, percentage of stock 1 is 55%, percentage of stock 2 is 45, and these are the earnings numbers, 71.5 and 29.25. So if you take the whole portfolio 1 and 2, what should the PE of this portfolio be? It should be the sum of the earnings numbers, 71.5 plus 29.25, So collectively this will represent the total earnings. The total price is essentially the total market cap, 715 plus 585. So if you add these two numbers and divide by the total earnings number, you will get 12.9. If you want, you can pause the video and make sure that you get that number. So we have a PE for stock 1 of 10 and stock 2 has a PE of 20. If you simply take the regular arithmetic mean, what do you get? You get 15, which is quite different from 12.9. What if you take the weighted mean? So that is being done over here. So you weight based on market cap, 55% into 10 and 45% into 20. There you get 14.5, getting better but still not at 12.9. Then you take the harmonic mean, and you might recall from level 1 quant, harmonic mean is given by this formula where n is the number of securities and then you sum up the reciprocals. So when you use this formula for the harmonic mean, you come up with 13.33. So we are getting closer. But when you use the weighted harmonic mean, then you get exactly the right answer. So weighted harmonic mean is given by this formula. 1 divided by the weight over the value. So that's shown over here. 0.55 into the reciprocal of the PE. PE is 10, so this is 0.1 plus 0.45 into 0.05. You get this number and take the reciprocal and you will get 12.9. So the weighted harmonic mean gives you the most appropriate answer. Now, what does this mean in practice? In practice, if you are coming up with your benchmark PE and you have 10 stocks in your industry that you feel are comparable, then you take those 10 PEs and you take the harmonic mean of those 10 PEs, and the harmonic mean is probably an appropriate benchmark. More on harmonic means. Harmonic means tend to mitigate the impact of large outliers. You might recall from earlier in the reading where we talked about mean versus median. And the regular arithmetic mean is heavily influenced by outliers. So clearly the mean is not as good as the median. And now we are saying that probably the harmonic mean is an even better. The harmonic mean also tends to mitigate the impact of large outliers. So it is not as impacted by large outliers compared to, say, the regular mean or the arithmetic mean. But the harmonic mean may aggravate the impact of small outliers. What is the good thing about small outliers though? The small outliers will be bounded at 0. A large outlier can be a very high number, but a small outlier is still bounded. And then this exhibit simply shows that when we are looking at arithmetic mean, so in this column you have PEs with outliers, right column you have no outliers. So arithmetic mean is hugely influenced by outliers. The median is hardly, in fact it's not influenced in this example, and the harmonic mean is influenced but only a little bit. Look ahead bias. Now, I don't think this is hugely important, but it is something that you probably saw at level 1, so you might as well learn what it means. When backtesting, be aware that time lags in reporting of financial results create potential for look-ahead bias. What does backtesting mean? Let's say you have an investment strategy where you are saying that you are going to buy based on a PE multiple less than a certain amount. So backtesting means that you apply this strategy to the past. You say that, okay, if 3 years ago I had bought stocks based on PE being less than 15, just as an example, that's a very simple trading strategy. And then you determine whether that strategy would have been successful or not. So doing that is called backtesting. But what are the risks when you do backtesting? Take an example where, let's say that at the end of 2008, January 2008, so let's say you are over here. So this is the end of 07 and you are here in Jan 08. Most companies had not reported EPS for the last quarter of '07. So actually in Jan '08, many companies have not reported numbers for the last quarter of the previous fiscal year. So at that time, a company's trailing PE would be based on EPS for the first, second, and third quarters of 2007 and the last quarter of 2006, which means that if you are actually here in January and doing investment based on PE ratios, you would not be taking the PE for all of 2007 because the data is not available. Any investment strategy based on the trailing PE that used actual EPS for the last quarter of 2007 could be implemented only after the data became available. Thus, if an analysis assumed that an investment was made in early Jan 2008 based on full year 2007 data, the analysis would involve look-ahead bias. The point being that if you are now sitting here in 2010 and you are doing a back testing where you are saying that had I bought in January '08, and sitting over here, obviously you have the EPS data for all of '07. So in back testing, you are using all of '07 data, but somebody who was actually here would not be using all of '07 data. So the issue or the bias that arrives because of that is called the look-ahead bias. And the way you overcome that bias is by saying that even if you're doing back testing, you should use the data that was available at the time. If you understood this, well and good. If not, it's not a huge deal. Last point now for this reading, using screens to find stocks for a portfolio. This is not explicitly mentioned in the learning objectives, but it is an important point. We have looked at several multiples. You as an analyst might want to identify stocks based on not just one multiple, but multiple multiples. And that is illustrated over here. You have a particular analyst and she wants to identify stocks such that the PE is less than a certain number, the EV to CFO is less than a certain number, the PEG ratio less than 1, dividend yield greater than 2.5, and she gives a certain range for market capitalization. There might be a database with 100,000 stocks, and when she runs a screen with all these criteria, then she ends up with a much smaller number of stocks that she can focus on. Now, clearly the screen that she defines is based on her investment strategy and what she's after. If you look at this screen, then it appears that she is a value investor. Why? Because she is looking for relatively low PE stocks. She is looking for a relatively high dividend yield. The market cap is 1 billion to 5 billion, so she's looking for mid-cap stocks. The point being that you can combine these multiple criteria and effectively create screens, and then you can more carefully analyze the smaller set of stocks that you get by running this screen. All right, let us now summarize this reading, and it is challenging to summarize such a long reading. Rather than list every point, what I'll try and do is highlight what I think is most important. You need to understand the distinction between the method of comparables and the method of fundamentals. With the method of comparables, we are basing our analysis on the law of one price, where we say that the PE ratio or any other ratio of a stock should be the same as the PE ratio for other similar companies. What do we mean by similar companies? It would typically be companies that are in the same industry with similar leverage and so on. So if you have this, let's say we are talking about the auto industry and you are evaluating a new company in the auto industry. So you figure out the benchmark PE, which would be the average PE of other companies in the industry. And then if your target company has a high price to earnings ratio in the market relative to the benchmark, that means that your target company is not very attractive, all else equal. If the ratio is low, the ratio based on market price is low relative to the benchmark, then all else equal, this would be an attractive investment. Then we talked about the method of fundamentals, which essentially connects with earlier readings on dividend, discount valuation, and free cash flow valuation. But here is your most important formula, where we say that the PE ratio is equal to the payout divided by R minus G, assuming the Gordon growth model. So notice here the PE is derived based on fundamentals related to the company. Again, you can come up with this PE. This is the justified PE based on the fundamentals, and then compare with the market PE. This is the PE based on the trailing PE number. And then this is price to book, ROE minus G over R minus G. There were other formulas, but I'd say that at least memorize the ones that I'm showing you over here. These have the highest probability of showing up. Multiple definitions of PE. Remember that the segment on PE was the longest in this reading. So there is the trailing PE and then the leading PE. In the leading PE, it is which 12 months to use. In the trailing PE, which 12 months to use. There was the concept of normalized PE, which considers a whole business cycle. Within normalized PE, you can either just take the average of the PEs, or you can use the concept of the average ROE and multiply by the final book value. So just remember the fact that there is a lot going on when we talk about PE ratios. Then, given a ratio such as PE, how do you compute what the value of a company should be? So remember the fact that, let's say you have period 1, and if you have a PE of 10, then you need to be careful about what E you are using. So if you have E1, this is a forward or leading PE. So how will you come up with the value of a company? The value of a company will be the leading PE times the earnings in the upcoming period. This is fairly straightforward. Then we went on to talk about enterprise value multiples or ratios. The most popular one is EV over EBITDA. And as with price multiples, the lower the better, all else equal. For every multiple, we had a slide which talked about the rationale for that particular multiple and then also the drawbacks. And the most common rationale that we talked about, and one associated with price to book, price to earnings, was that there is some evidence that relatively low ratios tend to, or there is some evidence that stocks with low ratios tend to perform well. So that was the major item. That is it for this reading.